The Fed has all but confirmed outright that there will be a very significant, basically, move to the downside in the near future. And tomorrow is absolutely critical in understanding where the market is going to be going, basically into the end of the year. And there are some things that everybody needs to focus in on in order to position themselves accordingly based on what is going to be coming out in the data report tomorrow. So we're going to be breaking all of this down for you guys, all of the key data points to look out for, the key price levels on the SPY, because at the end of the day, a lot of retail investors really only know how to go long in the market, and I want to make sure that you guys have the tools to protect yourselves against any further downside that we are going to be experiencing. So before we get into all of that information, guys, all I ask out of you guys, if you don't mind hitting that like button down below and hitting that subscribe button if you do enjoy these types of videos. And again, 1348 gang, it was another awesome day. Make sure you guys comment down below what was your favorite play of the day that you guys took. But let's get right into it here and kind of take a look at what's going on with the actual market. So what we have been seeing on the daily chart of the SPY is an aggressive hunt of this 1348 crossdown on this daily time frame. Now, if you guys have been paying attention to a couple of the other videos that I've been making, we are watching that 393, 390 level on the SPY. If we end up slipping 390, it could get very aggressive to this downside here too. The other thing that I want to kind of focus in on with you guys here is these daily crossdowns and daily cross ups recently. There's been a lot of volatility in the overall market, but as you can see, even on this daily time frame here, these daily cross ups are basically respected. You see this cross down here where we saw, I believe it's about a 16% move to the downside to these lows here, 17%. We see this cross up that does continue slightly. We see this aggressive cross down here too. We see these cross downs, cross ups. These overall moves in the market here, as kind of explained by the most profitable crossover strategy that has ever existed, is essentially telling you that we are going to be in for some more pain. Now, are we going to see these new lows? Well, it's very possible that we do, depending on what type of data comes out tomorrow and where the Fed is going to be taking us at the FOMC meeting a little bit later this month. Now, we could end up coming down to these lows here, this 380, 370 level here, or even these previous lows that are around 362. And just a quick shout out here, guys, I do want to kind of shout out some of our members over here. Lori's having an awesome time in our program here. We have a lot of people making some very significant gains over here with 1348 and this proprietary trading algorithm that we have unveiled recently. Now, Trader Joe's been around for a while here, and he's trading on this daily time frame. He's fully on autopilot. He tells you guys every single trade that he is taking here. Pythagoras, our predictive daily algorithm, is killing it as well. And kind of special for you guys here, it is the best time of the month to hop in if you guys are interested. So make sure you guys come down, check out that link down below. We have all those curriculum videos, all the live streams, all the alerts, and trading algorithms that you are not going to find anywhere else. But let's kind of get into some of this data here and exactly why tomorrow is going to be so important. And it's going to take us back about a month to kind of when the last kind of round of this data actually came out here. So the job market's latest report card has also helped ease concerns about hiring that were stirred up by anecdotes of cutbacks in the technology industry and at some retailers, including Walmart. Now, we've seen more of these organizations do this as well. Snapchat recently laid off about 20% of its employees. Now, while strong advance in payrolls and wages are welcome news for President Joe Biden, it's also likely to stifle the Fed's resolve to stay on the path of large interest rate increases. Now, what this means here is that if wages are actually going up, well, people are going to have more disposable income to spend in the economy, and with the overall macroeconomic environment, well, they're going to be spending that on goods that they need, necessities, every single day. Now, we've seen the cost of food start to significantly increase, and if these individuals, honestly, this is a really terrible way that our economy is set up. If people do have more money and do have jobs, that is going to increase inflation. Now, this brings us into tomorrow, which is why it's so important. Tomorrow, we have non-farm payrolls. We have the unemployment rate coming out, average hourly earnings, and labor force participation rate. Now, the unemployment rate is going to be pretty important, but I do want to kind of briefly talk about average hourly earnings, because I think this is going to be what a lot of people are going to be focusing in on that not a lot of people are talking about. When you take a look at exactly what our average hourly earnings are, it measures the change in the price businesses pay for labor, not including the agricultural sector. So it's essentially measuring how much people are making per hour at their jobs. Now, if this rate continues to grow and it actually doesn't come down, even if this rate doesn't actually go into the negative, well, the Fed is going to view this as still the job market and the labor market are still very, very strong, which is going to make it even more difficult for inflation to come down. Now, what does this lead to? It leads to the Feds continuing to stick to their guns and raising interest rates 75 basis points, maybe even continuing these 75 basis point hikes into the end of the year. Now, there's a couple of other things that I do want to briefly bring up as well. The unemployment rate. Now, looking at the previous unemployment rate data here, back in July, we see that the actual unemployment rate was about 3.6%, and that was about the consensus estimate as well. Looking at the August unemployment data here, we have 3.5% when the previous was 3.6%. Now, here's the interesting part about this. If you continue to see average hourly earnings go up and unemployment actually go down, meaning that there's more people going to be employed in the economy, well, then there's going to be more people making more money, spending more money in the economy, and further kind of supplying, that's a poor way to put it, but supplying the demand push inflationary aspects. They're going to be contributing to those demand pressures, bidding up a lot of these goods here. Now, the other thing that we need to talk about, and again, we're getting into September, it is one of the worst months of the year seasonally, just according to how the data has kind of played out over the last 10 to 20 years with the overall stock market. We're also getting an increase in the Fed's tapering. So the Federal Reserve's balance sheet unwind is set to ramp up this week, which means the central bank will finally begin unloading the treasury bills it started amassing almost 3 years ago. As part of its broader plan to reduce its $9 trillion portfolio, the Fed will boost its monthly caps for the amount of treasuries and holdings of mortgage-backed securities that it will let mature to $60 billion and $35 billion respectively, while using its $326 billion stash of T-bills as filler when coupons run below the monthly level. September will be the first month that bills will be redeemed since coupons will fall below the monetary authority's new cap. So what we're essentially seeing here is an increase of supply in the bond market, more selling pressure coming in from the Fed as they decrease their balance sheet. Again, these are not great things going on in the economy and the overall macroeconomic environment headed into the end of the year. Now, going kind of back and wrapping this all up so you guys have a good indication of what we need to look at going into tomorrow, unemployment rate, average hourly earnings, labor force participation rate is going to be important as well, because you're going to see, well, are people still continuing to participate in the overall economy? Now, if you do see the labor force participation rate actually go up, that could be a contributing factor to decreasing unemployment as well. But again, if you see labor force participation rate actually go down, it decreases GDP. So I would say that's kind of a wash on that data right there. But average hourly earnings is going to be very important, combined with that unemployment rate as well. So again, tomorrow is going to be incredibly important. And again, kind of going back to what we're seeing on the market here, we are seeing a lot of volatility. We have seen this significant sell-off here, but what you have to think about is what would entice these large buyers to come back into the market. What is the reason why large institutional money would kind of come in and put all of the cash that they have sitting on the sidelines back into the market right now? Well, recently, we've kind of seen a lot of messages from the Fed, as we were talking about in a previous video, that it really doesn't make any sense for the Fed to kind of aim at decreasing interest rates at the end of 2023. So that light at the end of the tunnel, kind of gone now, that the Fed is kind of sticking to their guns and saying we need to get inflation back down, almost at any cost here too. Now, after Friday, we are going to be getting the CPI data as well, and the FOMC meeting coming on later this month. So those are going to be some really, really key factors. But tomorrow, the Fed is really going to be looking at this data to really confirm kind of where the overall labor market is and where they see rates going based on the labor market going into the end of the year. So guys, that is kind of going to wrap up this update here on what we have going on going into tomorrow. If you guys did enjoy the information and analysis that I provided for you guys in this video, make sure you go down and hit that like button. It costs you nothing to do it, but it really helps us out a whole lot in getting this information out to as many people who want to learn. And if you guys do want to see more videos like this, make sure you hit that subscribe button and turn on that notification bell so you're notified every time I post a new video. So I hope you guys are having a great evening. I'll see you guys in the next one. Peace.